All right, today we are tackling an investment that's got a lot of people talking. It's an ETF with the ticker TLWT, and it's making waves for one simple reason: a huge, eye popping yield. So the big question is this a brilliant move for income, or is it a trap waiting to spring? And this is the number, a trailing dividend yield of over 16%. I mean, come on. In a world where every single basis point of income matters, a number like that is pretty much impossible to just scroll past. And whenever you see a number that high, the first thing that pops into your head has to be, is this too good to be true? Is it for real? Is a yield like this even sustainable? Or is there a catch? Is there some hidden risk that's going to come back and bite you later on? To get to the bottom of that, we've really got to pop the hood and see how this thing is put together. Because let me tell you, this is not your typical bond fund. So let's break down exactly how TLTW manages to combine two pretty different financial tools to cook up that impressive payout. So here's the deal. At its core, this thing is a hybrid. On one side, you've got long-term U.S. Treasury bonds, the same stuff you'd find in any plain vanilla government bond fund. But then, and this is the secret sauce, it adds a second layer right on top, a very specific options strategy. And that strategy is called a covered call. Now, don't let the jargon scare you. Think of it this way. Imagine you own a house. That's your asset, right? In this case, it's the Treasury bonds. Now you agree to sell what's called a call option. This is kind of like renting out the potential for your house's value to skyrocket. In exchange for putting a cap on how much profit you can make, someone pays you an upfront fee, right now in cash. That fee is called a premium. So you get money in your pocket today, but you give up some of that massive potential upside. So when you put it all together, this setup gives TLTW three different ways to generate returns. First, the obvious one. It earns interest from just holding the Treasury bonds. Simple enough. Second, it gets all that extra income it collects from selling those call options. And third, it can still make money if bond prices go up, but, and you have to remember this, only up to a certain point. That's the trade-off. And really, this quote from the source material just nails it. This is the fundamental bargain at the heart of TLTW. You're giving away your shot at a home run, a huge jump in price, in exchange for getting more consistent, higher income today. Right, so that's the theory. But how does this all play out in the real world, under pressure? Let's walk through three different potential scenarios for the market to see exactly where a fund like TLTW would shine, and maybe more importantly, where it would really struggle. Okay, take a look at this table. First row, imagine bonds have a sharp rally. Maybe interest rates fall. A regular bond fund would capture that whole gain. But TLWQ, it's going to underperform because its gains are capped by those options it sold. Now look at the middle row, a flat, sideways market where prices don't do much. This is where TLWP is built to win. That extra income from the options gives it a big leg up. And finally, what if rates rise and bonds sell off? Well, those option premiums act like a little cushion, meaning TLW actually loses less money than a pure bond fund would. So when you see that performance profile, you can start to understand why some investors are getting pretty excited, right? Let's dive into the bull case, the argument for why right now might be a really interesting time for a strategy like this one. And the bull case is actually pretty compelling. First, that monster yield can be the main driver of your total return, especially if you think bond prices are just going to chop around in a range. Plus, choppy, volatile markets mean those option premiums are richer, which just turbocharges that income engine. And like we just saw, it gives you that built-in buffer against moderate losses. It's really a unique tool, especially for investors who are laser-focused on income and expect the market to just go sideways. All right, but we've got to be balanced here. As we all know, there's no such thing as a free lunch in investing. So to get the full picture, we have to flip the coin and unpack the very real and pretty significant risks that come along for the ride. And these risks are a really big deal. The number one thing you have to understand is that capped upside. If you're wrong and interest rates fall off a cliff and bonds have a massive rally, you are going to be left in the dust. And don't forget, you still own long-term bonds. So if rates spike higher, the price of your fund will fall. What if the market gets super calm? Well, volatility collapses. Those juicy option premiums dry up, and the main advantage of TLTW kind of just vanishes. And then you have to factor in the management fee and potentially more complicated taxes. You can see the downsides start to add up.
Okay, so we've been through a lot here. We've seen how it works, the best case and worst case scenarios, and the arguments for and against it. Let's boil all of this down to the final key takeaways you need to make your own call.
When you really get down to it, it all boils down to this. Their goals are just fundamentally different. TLTW is designed from the ground up to maximize income. A pure bond fund is built to maximize total return. So TLTW is the tool for a sideways market, while a regular bond fund is what you want when you expect rates to fall hard. They're just different tools for completely different jobs. So if this strategy sounds interesting to you, here's your dashboard. These are the things you've got to watch. Number 1, long-term Treasury yields. Number 2, market volatility, because that's the fuel for the fund's income. You have to keep a super close eye on the Fed and inflation data, because that's what moves the bond market. And finally, track the fund's actual monthly payouts. Is that high yield actually showing up in your account? And that all brings us to the final crucial question that every single person thinking about this fund needs to answer for themselves. By choosing this, are you making a clever trade, locking in a high stream of income for today? Or are you just giving away your ticket to a potentially massive bond market rally tomorrow? The right answer? Well, it depends entirely on what you think the future holds.